Welcome to this explainer. You know that feeling when you first look at a price chart and it just looks like this chaotic, overwhelming mess of zigzagging red and green lines? Yeah, take a deep breath. You're in exactly the right place. Today, we're taking those intimidating trading concepts and we're transforming them into highly actionable tools that you can actually use. We're going to completely demystify the markets by mastering support and resistance.
Let's be real for a second here. Are you totally fed up with entering a trade, feeling super confident, only to watch the market immediately pull a U-turn on you? Or, I don't know, maybe you're constantly getting stopped out right before a massive move in the exact direction you predicted. It is so incredibly frustrating. But the good news is you can absolutely fix this. It's time to stop guessing, stop acting on pure emotion, and start mastering key price levels. And that's exactly what we're going to do right now.
All right, Section 1, the foundation of trading. Let's establish exactly why these levels are the absolute bedrock of your trading success. So, what exactly are key levels? Simply put, they are specific areas on a price chart that have played a really major role in the past, and because of that, they're highly likely to hold up again in the future. See, financial markets are completely driven by human psychology, fear and greed. And because of that human element, these markets basically have a memory like an elephant. Recognizing where buyers or sellers previously made a major stand is really step one to becoming a proficient trader. Now, why should you actually spend your time finding and drawing these levels? Well, because doing so directly protects your capital. When you understand key levels, you can pinpoint highly precise trade entries. You'll dramatically improve your exits, meaning you're taking money off the table at the absolute perfect time. It helps maximize your profits and protect your trades, but most importantly, it takes all that pure emotion out of the equation, replacing it with cold, hard logic so you can achieve a much higher win rate. Moving right along to Section 2, Floors and Ceilings Explained, let's break down what these invisible barriers actually look like in practice. The easiest way to think about this is to picture a room inside a house. First, you have your support level. This acts as your floor, literally holding the price up. Every single time the price drops and hits this floor, buyers step in and the price bounces. On the flip side, we have resistance. That's your ceiling. Whenever the price rallies and hits that ceiling, sellers take control, pushing the price right back down. It's kind of like banging your head on the roof. Honestly, once you start viewing your charts as just a series of floors and ceilings, all that initial chaos starts to make perfect sense. Which brings us to Section 3, drawing your levels correctly. We know what these floors and ceilings are, so now we need some strict technical rules for actually mapping them out. Precision is everything here. So here's your framework for drawing flawless levels. Rule 1. Support and resistance levels are always horizontal, period. Rule 2. You need at least 2 distinct historical touches for a level to actually be valid. Third rule, always start your analysis on a higher time frame. A daily chart carries way more institutional weight than, say, a 5-minute chart. Now here's a quick pro tip. Switching your chart over to a simple line graph can really cut through the noise and help you spot the best levels. And finally, when you're drawing these horizontal lines, it is totally okay to cut through a candlestick wick. Those thin little lines sticking out of the candles. But, and this is a massive but, here is our absolute line in the sand. You never cut through a candlestick body. Under no circumstances should your horizontal line ever slice through the solid, thick body of a candle. The wicks, those just represent momentary extremes. But the solid body, that represents the actual consensus of the market. If your line cuts right through a body, well, it is simply not a valid level. Okay, Section 4, upgrading entries and exits. Let's take these perfectly drawn, rule-abiding lines and actually apply them to a live trading scenario. If you want to time the absolute best trades, you have to follow this exact 3-step sequence rather than just jumping in blindly out of FOMO. Step 1, patience. Just wait for the price to actually reach your key level. Step 2, drop down to a lower time frame so you can really zoom in on the price action. And step 3, look for clear confirmation, like a pattern breakout or a strong rejection, before you ever risk your money. Don't just assume a floor is solid just because it's there. Make the market prove it to you first. Now, what about getting out of a winning trade? You always want to set your take-profit target just before the next key level. Why? Because the whole world sees that exact same ceiling. If you hold on hoping to squeeze out every last penny, the market is probably going to reverse just shy of it as other traders front-run you and take their profits early. So play it smart. Get out right before that invisible wall. And on the flip side, to protect yourself,
always tuck your stop loss safely behind the support or resistance line. Think of that key level like a thick, physical titanium shield. By hiding your stop loss on the other side of it, the price has to completely shatter a historically proven barrier just to trigger your exit. Trust me, making this single adjustment will drastically reduce the number of times you get faked out of a trade. As we wrap this up, the single most powerful takeaway from our source material is this: support and resistance are totally universal. It really doesn't matter if you're trading tech stocks, forex, or crypto. It doesn't matter if you day trade on a 15-minute chart or if you're long-term investing on a monthly chart. The psychology behind floors and ceilings is literally the universal language of the financial markets. So, I'm going to leave you with a question to really reflect on before you place your very next trade. Are your entries based on a clear, objective strategy using historical key levels, or are you kind of just guessing, rolling the dice, and hoping for the best? It is time to make that transition from gambling to truly trading. Thank you so much for joining me for this explainer, and happy trading.